Real estate investment practice problem using OneNote. Amortization schedule with table and slicer. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, note that we're in the icon on the left-hand side. We're in the Practice Problems tab. We're in the 4030 Amortization Schedule with Table and Slicer tab. Also note when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. We're going to be looking at this information and how we can use Excel to enter a table into the amortization schedule, giving us a little bit more functionality. We do work this practice problem in Excel, but we want to look at it here without going into all the formatting details of it, so you can get the idea of the process, compare and contrast it to online type of calculators, so you can see if the added flexibility is worth your time to implement it. And then if you would like to go to the Excel worksheet, either to construct it yourself along with the instructional video or just use that worksheet for whatever purposes you need it, then you can take a look at it. So we got our information up top. We're going to say that the starting point is the home, 500,000. Remember, if you're populating this into something like a worksheet, your goal is to populate the information up here and try to get everything as automated as possible so that it will update automatically if you were to make any changes to it. So if we were to make changes to the home price of 500,000, it would automatically multiply times the 20% if we set up our worksheet correctly in a spreadsheet, and that would give us our 100,000 down payment. We have the 500,000 amount minus the 100,000 down. That would be the loan amount of the 400,000. We're going to say the years are 30. That'll be kind of standard, but whatever years, 30, 15, and so on, times 12, 30 times 12 months would give us the amount of the months, which is when the payments are going to be paid from. 360 for a 30-year loan. The rate is 5%. Remember that the rate is going to be the yearly rate. So whenever we hear a rate, we basically hear a yearly rate typically, unless told otherwise. We're going to be calculating on monthly bases. So remember, this is 0.05. If you took the monthly rate divided by 12, it'd be a very small number, 0.41666% about. And so that's why we basically communicate with yearly rates, or one reason in any case. And but you need to be aware that you need to know that a rate means per time frame, and we're generally going to be working with monthly time frames here. We've got the payment calculation, which we focused in on calculating in a prior presentation. This is often the thing that you will be calculating on the data up top, and often making your different types of projections based on what the changes for the payment calculation will be. Excel has a nice function that can do that, being determined on the information up top. We can also calculate quite easily the total payments, because for the life of the loan, it would simply be the payment, which is fixed, 2147.29 about, that's rounded, times 360 payments for the 773,024 about, minus the 400,000 loan amount, 400,000. That would give us the amount of interest we would pay over the life of this thing. So the totals are not that difficult for us to see. What is difficult to see is the breakout between interest and principal as each period goes by, as each year goes by. That then often being important, especially if there's going to be a tax implication with regards to the interest being deductible and the principal possibly not being deductible, as well as the ending loan balance, which could be a significant factor if we are expecting to sell the property in some future point. So note, last time we built this amortization schedule, and last time we built it with an eye towards basically not making it into a table, either a pivot table or a table with a slicer. Here, we're going to think about the slight changes you might put in place if you were to build this table, and think about making it into an actual table with Excel terms of a table, which you can then put a slicer into and or create a pivot table with. So we just want to have an idea of what some of the changes, what some of the differences would be with your amortization schedule. So we won't go over just the calculations of the amortization schedule. You could take a look at the prior presentation on it. Just a quick recap of what the table looks like. We've got the years, we've got the months. These are going to be the periods. Let's just delete this whole thing. We got the payments, These are going to be the standard payments that came from up above. The interest is being calculated. This is the thing that's often going to be varying or will be varying greatly from period to period over the 30 years, as well as the loan reduction and the impact on the loan balance that will be at the end of the period. These are things that are typically we want more detail on. Now remember, you can use an online calculator such as this, and this is just one online calculator. You can use many different ones, and you have similar information. The data input can be constructed in a similar way as with our worksheet in Excel. You could run the table. It'll give you the monthly payments, the totals calculated up top, and it'll even give you the amortization table. But from here, you can't really create this into, say, a pivot table too easily. You could try to copy and paste it or something like that, but still, it's kind of tedious. And so it'd be easier just to kind of construct this typically and then be able to do what you want from, say, a pivot table or a slicer type of table, as we'll see here. So you can kind of compare and contrast. I would use this kind of calculator as a double check to see that the numbers I'm putting in my Excel worksheet are correct, then use our Excel worksheet in order to do further calculations that are specific to my particular needs, checking them where I can with other sources if possible. So then I'm going to go back on over here. So that means if we were to construct this table and have an eye towards building a table as opposed to not adding a table to it, then the major changes would be if you have a header up top. Notice there's two lines on this header up top. So if I wasn't going to make it into a formal table in Excel, I would put those on two actually separate rows in Excel and then make it look nice by basically making the whole thing black and white so you can't see that it's in two cells. The reason for doing that is that it doesn't mess up anything to the right of it or to the left of this table. I can put another table over here and I don't have this really wide row that messes anything up to the right of it or to the left of it. However, if you're making a table out of it, then you're going to need to put them in one cell because the table will not be able to read the fact that you have two header rows involved in it. So that's one change you got to just keep in mind if you're going to be building something into a table. Then, of course, you can wrap the text or have Alt-Enter and then have these two rows, but then you got this widened cell that's going to be up top that you just got to deal with in the event that you're going to have this. That's how you're going to format the header because you want the table. All right, and then other things just to remember when you're going to build a table from it is that you want to have something in basically each cell of your amortization table. So with regards to an amortization table, remember we have the years and months here. This 0 up here, you might neglect to put a 0 there and have a blank cell. If you do that, it can kind of throw off the table to some degree. This payment section here, this interest, this loan balance with 3 zeros, typically you could just leave those blank normally. But you know, if you'd rather have a value in there so that if you were to use especially a pivot table, it would have something to be pivoting on. The other one that's going to be important is that the years here, you might just say, hey, look, I only need 1 year at the year's start. So I might should 1 here and have no years down here and then have a 2 here and then nothing down here and then a 3 and so on and so forth. Now, remember, just formatting these years is a little bit tricky. So we have a little trick to do that in Excel. We won't get into that now. But also, you don't want to do it that way, especially if you have a pivot table, which we'll do in a future presentation, because you need something in each cell for it to pivot on. So I need each cell to show that it is in year 1, so that if I wanted to pivot on year 1, if I wanted to sort the data by year 1, it can pick that up from this row and be able to sum up the data per column or per column and so on. So we'll do the pivot table in the future, but those are the two major differences that you want. Make sure your headers are properly input. Make sure that you have something in each cell whenever possible. And then obviously at the very bottom, this total column down here, you don't really need a total column because when you make the table, you have the option of adding a total column, which will then sum up the items as well. So the total column also will throw things off. You don't want the total column. You want to use the table to sum up the total and add the total column in that way as well. So those are going to be the major differences with a table. Once you have your data just in those slight little tweaks into a table, then you could just go to Excel. You can go to the Insert tab instead of the normal Home tab, and you can add the table, which is this item here. Not a pivot table yet. We'll do that in the future, but just a normal table. The normal table is kind of nice. You because you can sort things by the normal table, which you don't really want to do too much with an amortization schedule most likely, but you can also filter with the drop downs. And one other way that you can use the pivot table in that filter way, because the primary way you're probably going to want to filter is by year. I'd like to see year 1, year 2, year 3, so that I can then see how much interest and principal will be filtered out. And for that, you can add the slicer here. The slicer gives you this nice button, which is in essence a filter, which you can also do with the drop down and filtering. But the slicer gives you that breakdown by year, which is quite nice. So I'm going to scroll down here. We're going to get down to the bottom of this thing. And if you use the slicer here, then you could do something like, if I want to see just the data for year 1, you can hit the year 1 slicer, and then it's just going to sort. Notice it filtered, and this is why you need a 1 on each of the columns. It's going to sort by that year 1 and just show you the filtered items for year 1, and then you can sum up the interest and payments and loan amount quite easily for that particular time frame, which could be useful for your tax planning, because you want to know, one, how much your payments are, but you also want to know how much the interest and the loan will be, how much the interest and the loan reduction will be, as well as what will be the loan balance at the end of each period. And then, of course, you could do that for period 2. You could say, here's year 2, sliced out period 2. You got the total on down below, totals it up for you. Payments, interest amount's going to be different than it was for year 1. I didn't copy the total here, but you'd have a different interest amount. And then you want to know what the loan balance is at the end of period 2, year 2, in the event that you're thinking about selling the property at some point in time, and you're trying to think about how much proceeds you would get after you pay off the loan. Obviously, if you go down to period 20 down here, well, not, if we go to period 20, 25,767, same amount of the payment, because the payment is the same, but the interest substantially different, 19,564 versus the 10,538. And then you could check out the loan balances at any period. So you could say, well, what if I sold it, in 20 years or something like that? What would be the loan balance? What would my proceeds be? And so on and so forth. Now, the other thing, this is really nice right here to be able to slice it. The slicer has some limitations, though. One is that when you use the slicer, it actually hides columns. When you slice it, what it's doing, it's basically filtering the whole row. So if you have anything to the right of your table that you're working on, the slicer kind of messes it up because it hides the whole row, which means it's going to hide all the data on the right-hand side. So that's kind of a problem with the slicer. And also, the slicer, although it gives you that nice data on a one-by-one basis, something you can't do so easily generally with an online calculator. You'll see this data on an online calculator. I can't really slice it that way too easily. You might have some other calculators that have more functionality than this one, that does more stuff. But notice it's never going to do everything you want it to do when you're trying to do something custom to you. What you'd like to do is, use this to help check that your numbers are good, and then do what you want to do in a more flexible way is what I would suggest, what I would think. So in any case, it gives you that one by one, but it doesn't give you the side by side. Like what you might want to see then is say, I'd like to see, how much interest I pay on a year by year basis for 30 years in one place, instead of having to jump from year to year. Now, the easiest way to do this would be then to use pivot tables, and we'll take a look at the pivot tables later, but they can be kind of daunting for people. So we'll start working with them a lot more later, but you can use this slicer to build that as well. So obviously you can go into each year here, copy the data, and then basically put it into something like this, which means it would be nice if I could break the data out, instead of having 360 amortization table, super long schedule, I'd break it out by year here, 30 years, and I could have the same payments per year, which will be easy to calculate because they're all the same. But then I can have the interest summing up the interest. So this is just simply adding up the interest, say for year 20. So we had the 11 or the 10,538, the 10,538, right? I can just copy this data and put it into a year by year data, meaning copying the summary data here and just pasting this one down in year 20 here. And it would take 30 copy and pastes, pasting it 1, 2, 3. But without too much trouble, I can create a schedule like this, which gives me a side-by-side breakup. This schedule will not change automatically as I change the data up top. But that's one thing you can do. It's a lot. We can do more flexibility with the pivot table, but just realize you've got some more kind of options when you add the tables to it. And this is one way we'll construct it. So we will do this in an Excel worksheet if you want to add the pivot table and see how to put that into an amortization schedule and see if that is beneficial for you. In a future presentation, we'll talk about the same kind of thing, but that time adding this is adding a slicer, adding a table and then a slicer. In a future presentation, we'll add the pivot table, which is another degree of complexity. And the pivot table can get a little bit glitchy and it's a little funny, but it adds it makes this process a little bit easier as well. So we'll take a look at that in future presentations.